Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, I'm thrilled to be joined by investment strategist Ryan Grabinski. Ryan, how are you doing today?
I'm doing well, Ross. It's always good to be back.
Yeah, good to have you here. And we have you here to talk about the market gauge. So you all published a new edition of this trademark piece this week, and in the piece, basically what you do is take 16 building blocks of the markets and the economy, and basically say good or bad, asset or liability, favorable or unfavorable. And it might seem like a simple exercise, but I think it's a really great way to get a picture of the market at any one time. So without further ado, you left it unchanged. It's kind of evenly weighted right now. But in the title of the piece, you noted that virtually every category is on watch. So I wanted to get your high-level thoughts on the gauge, and then we can dive into a few of the details.
Yeah, that's exactly right. So, we felt it was worthwhile to leave the gauge unchanged, just given that it's supposed to be a snapshot in time. But obviously, there's some concerns about economic growth starting to slow here. Obviously, we got a good retail sales number yesterday, so that ebbed a little of the concerns there. Obviously, sentiment is not overly bullish right now with the equity market selling off some. Sentiment is we have no items checked off in our sentiment checklist. And then lastly, fiscal policy is set to slow into 2022, obviously coming off of the accommodative stance that we saw from policymakers, just given the COVID backdrop and everything.
Yeah, and so you mentioned fiscal policy, which is set to slow, but I think kind of the biggest point of precipice that we sit on right now is monetary policy. Inflation is as hot as it's been in 40 years, and so it's spurring the Fed into action. Monetary policy and liquidity, which is kind of a second derivative effect of policy, is still an asset, but I wanted to get your thoughts on where we sit right now with that whole picture.
Yeah, obviously, all eyes are on the Fed. The Fed's the market is basically expecting the Fed to hike rates in nearly every meeting this year. We left it as an asset for now, simply because if you saw the latest Fed purchases note that was released last Friday, they're actually going to be continuing to still purchase treasuries, although the pace is slowing somewhat down from 40 billion down to 20 billion over the next month. They are still purchasing, so at the end of the day, they'll remain easy. We do expect that they will eventually end the purchases as they've indicated, and will at that point, the market will start to think about quantitative tightening more, and whether that just means balance sheet runoff or actually actively selling securities off their balance sheet.
So tighter policy imminent, almost certainly. One other key building block of the equity picture and the market picture is earnings. So you mentioned consumer healthy. The policy piece is kind of in the middle of things right now, but we're in the middle of an earnings season right now. From a high level, things still look pretty good. What are you seeing as you dive into the earnings numbers?
Yeah, overall earnings are expected to be up around 30% this quarter. Obviously, that's down from the elevated levels that we saw in previous quarters, but is still high overall. I think the one kind of thing to pay attention to is the surprise ratio. Companies are not surprising to the same extent that they were in previous quarters. That suggests to us that analyst estimates are actually catching up to what companies are actually reporting. I think the other thing to pay attention to is on the margin front. Operating margins are beginning to stall out here. This is really more of a function of cost growth. One of the things I'm watching most closely there is if revenue growth can continue to outpace cost growth, margins can sort of maintain their current levels. If something on that front begins to change, then it'll be a little more concerning. And typically, when margins are sort of flat to rising, the market doesn't get into too much trouble. But when they begin to roll over, that's when we start to get a little more concerned about the aggregate index overall.
Yeah, absolutely. Well, it's a lot to watch heading into a new year. I think it kind of sums up the picture right now very well. Optimistic but cautiously so, with a lot of items to keep on the watch list. And that's why we're glad to have you guys on the team. So we'll be checking back in with you, I'm sure. And we appreciate the time today.
Thanks a lot, Ross.